today's class, and today we are going to cover introduction to forex trading. Just a basic introduction, but it will have some bit of what we did yesterday, just to have some flow as we get deeper into forex trading, right? So we start with defining the word forex trading. Please remember, you can always interrupt me anytime to ask a question or seek clarification, all right? You don't have to wait until the end of the lesson. Anytime you have a query, you can always raise it up, then we can address it before we proceed to the next session. So we want to define forex trading, and we say forex stands for foreign exchange, just a short form of foreign exchange, which is exchanging one currency for another. That's why we said yesterday, we always do forex trading in pairs. Anytime you buy one, you're automatically selling the other one. So you're exchanging the two. So like in the case of Euro USD, if you buy that pair, you're actually buying euro and selling dollar at the same time. So you're exchanging the two. Yes, so they always dealt in two of them. So it's the exchange of one currency for another. That's what we call forex trading. And we said forex market is the largest financial market in the world in terms of volume of the amount traded, all right? As when you compare with the New York Stock Exchange, which in a day they exchange $74 billion in forex market. In one single day, there's an exchange of more than $5.5 trillion. Yeah, so it is the most volatile market, the most liquid, and the biggest market, or the largest market in the financial market. So it has also many players, yeah, because it has all those big banks, the hedge funds, those are the fund managers, and retail traders like me and you. So anyone can always participate at any time. So when you're trading forex, you buy and sell currency, just as we said. Remember, we said they're always in pairs. So anytime you buy one, you buy the base, you're automatically selling the quoted currency. You sell the base, you're automatically buying the quoted currency. You exchange the two currencies. So like assuming you're in America visiting Japan, you have traded the dollar for the yen. So remember, forex does not only happen in the normal buying and selling, but even in like other transactions, like in Kenya, we import cars from Japan, right? So already forex is happening because we cannot pay the Japan seller in Kenya shillings. We have to exchange in yens. So forex always happening continuously without even any planning. When people travel for holidays like Mauritius, already forex is happening. So it's a continuous market which has no borders. Yeah, it has no borders. It's always continuous. Yeah. So when trading forex, you buy and sell currency, and that's what we said. So buying a currency is it's like buying a share in a country. So the price of the currency is a direct reflection of what the market think of the future health of that economy. So like just a country is like a company, yeah? So if today you realize Safaricom was performing so well, yet they released their financials, so they're doing so well, everybody will want to buy the shares for Safaricom. Why? Because we want to get good dividends once they release their end of year results. So when you check their quarterly, then the other, and you can see there's a trajectory that they're performing better and better. You will go for the price of that share for Safaricom. The same case with currencies, all right? So a currency, the strength of a currency, it reflects the strength of the economy of that country. So the economic data, when it is being released, yeah, like the GDP, the inflation and all that, that is what the investors use to value the currency of that country. So when you buy to value the economy of that country. So when you buy dollars today, it's like you're buying a share of the US economy. All right, what you are saying, buying a currency is like buying a share in a country. When you're holding your dollar, you're hoping the economy for America is gonna go up. They continue growing up and up, so their currency is going to appreciate. So you hold it, expecting as the economy for America gets better and better, their currency gets stronger and stronger. So you will release, or rather you will sell it or liquidate it when now you see it's likely to start coming down. Basically, the same way you value a company, we can also value a country based on the economic data. And you're going to see the key economic data we look at to know how the economy of that country is doing. Like this period, most of the companies in America, they are releasing their earnings. Talk of the Facebook, talk of the, those Amazon. Like yesterday, the reports released were pretty good. Their earnings were way above what the market expected. So what happened? Dollar just jumped. The indices like the SP 500 and Wall Street 30, you'll know what all that is with time. So when the earnings for the companies of that country, they are going up. They're already telling us the economy of that country is going up. So what happens? The currency appreciates. Like that was the case. Like yesterday, dollar was really the king. Yes. So everything else, it was just outperforming all the other major currencies because of the good earnings report from the major companies in that country. So it shows the economy of the US is doing very well. All right. So the price of the currency is a direct reflection of what the markets think of the future health of that economy. All right. Actually, what happened, like 2 weeks ago, there was a report released by, not really 2 weeks, but just some period back, by IMF or World Bank, one of the two, saying they were expecting the economy of the world to start contracting. So because of that, the technical analysis was actually showing indices like the SP 500 and the Wall Street that they're already like coming down. Yeah. So the market, the investors, they rely on the prediction. They predict the economy to go down. They start running away from that currency, running away from investing in the economy of that country. But if the reports come much far better than expected, then the economy rebounds. The investors change their mind and they start investing back. They start buying that currency. That's exactly what happened, because like a week or two ago, SP 500 had already shown a signal of starting to go down based on the expected earnings of the major companies in the US. But when the data was released, like yesterday's data was pretty good. So the investors were like, no, the predictions were not good. The economy is getting better, so they invest more. So when they buy that currency, it appreciates more, right? Great. So in Forex market, we see it a 24-hour market. It runs for 24 hours. But again, as we said yesterday, it does not just run like one market open throughout. It's usually in sessions. So one session runs, it like before it closes, another one just starts. So like they hand over to each other. So in total, the market is operating in 24 hours. Remember, there are no boundaries. So we are saying when the Asian session is operating, you can transact. When the London session is in session, you can transact. When New York is in session, there's no limitation of, for Asian market, Asians to operate or whatever. It is global open market for anyone to participate. So what happens? The Asian session starts around 1 a.m. in the morning. Then at around 10 a.m. South African time or 11 a.m. Kenyan time, the London session opens, right? So once they open, there is some overlap or like an hour or two, then the Asian market closes. The London will operate until around this hour, 6 or 7 p.m. South African time. So there is an overlap. No, that time, the New York session will have opened around 2 p.m. South African or 3 p.m. Kenyan time, all right? So there are moments the major sessions overlap. And that is the time you find the market is very liquid, the market is very active. So when the market is very liquid and is very volatile, we say the pairs move very fast, and that is the best time to trade because you don't have to hold your position for long. Even if you're not closing your position, once it goes into profit, as you saw yesterday, you can comfortably move your stop loss, lock in your profit, and let your trade run risk-free because you've already protected your trade. It cannot now run into a loss, all right? So these sessions, they hand over to each other, and there are moments they overlap, which makes the volatility to be a little bit high. Remember, you don't have to cram what time they close, but there's a place you can always check to know which one is in session, which one is closed, and which ones are overlapping. So the Asian session, London session, and the New York session are the major sessions. Yeah, but we have other smaller sessions, which is the Sydney and the Frankfurt sessions. So actually, Sydney starts first. Once New York closes tonight, Sydney will come before the Tokyo market opens. Right? Again, we say, although the Forex market is a 24-hour market, it closes on Friday evening at midnight and open on Sunday evening. So at least they don't operate on weekends. So by Friday at around, okay, midnight, remember, midnight is relative, depending on the time zones you're in, all right? But it's roughly around 11 p.m. Kenyan time or thereabouts, all right? So it closes on Friday evening, then it opens on Sunday at around 1 a.m. Now the session starts again. The city will open, then Tokyo will follow. Then from there they continue. The same cycle continues until the next Friday, 24 hours until they close on Friday. So remember again, we said here in Forex, we only trade currencies. So, and we say there are 8 major currencies that are traded in the Forex market. The currencies are quite many, yeah, but we focus on the 8 major currencies. They are called majors because they are the most widely traded ones. So you're safer trading the ones that are commonly traded because it means you can dispose anytime, you can buy anytime, and there's always a buyer somewhere, there's always a seller somewhere, right? And they also move very fast. There are pairs you can actually buy, like, which one do I say? Which they just don't move. Because again, the investors, they may not consider so much the economic data or the happenings in those countries. So no one is really interested. So there's nothing to trigger them to really move as compared to the 8 major currencies. So we mostly focus on the 8 major currencies, but with the time you can always feel like, wait, I can always try the minors or the exotic ones. You're still free. They are always there. But it's good to focus on the 8 major ones so that you're able to, you don't have to hold your positions forever for a month for you to get profit. You have to be profitable. So currencies are denoted in symbols, and the currency symbols always have 3 letters in them, with the first 2 letters representing the country and the last 2 representing the currency itself. Yeah, like for example, the letters, USD, US represents United States, while the letter D represents the dollar. So that's how they are denoted, or rather they are named, they are symbolized. That's how they are symbols, how they are derived, okay? And we have cases there. US dollar for US, nickname, we saw the nicknames yesterday, and we say the nicknames, many times we read analysis from other analysts, and they are likely to quote in nicknames. So you don't want to start wondering, what is this fiber here, and what do they mean? At least you know the nickname for the 8 major currencies, all right? So US dollar for US, it's called greenback. Euro for Europe, called fiber. GBP, and also it's good to know Euro is used by 27 countries. I will remember to share with you because you need to know which countries use which currency so that if there are happenings, like if something is happening in Italy, you know what's likely to happen to the Euro because they use Euro. I know, I think, is it this month or next month, I'm not sure, Spain will be going into elections, all right? That's already a geopolitical issue. And depending on the outcome and how the investors view the incoming president, is likely to affect the euro. So you need to know which countries use euro so that you know if there's anything happening in those countries, it's likely to affect euro, either positive or negative, right? Then we have the GBP for Great Britain. Nickname is cable. We have the CHF, franc for Switzerland. Nickname is Swissie. CAD dollar for Canada. Nickname is Loonie. The JPY yen for Japan. Nickname is yen. Then we have the AUD dollar for Australia. Nickname is Aussie. And then NZD dollar for New Zealand. Nickname is Kiwi. All right. So these are the 8 major ones. So what happens, usually paired, they are paired together such they produce around 16 pairs or thereabout. You'll find you have Euro USD, Euro GBP, GBP USD, but you don't have to really stress yourself to cram which one comes before which one. How are they paired? Is it Euro USD or is it USD EUR? They are always in the market chart. They always, yours is only to pick and put it on your price chart. They are already paired for us. You don't have to struggle to know which one to pair with which one. The only thing we need to know, if dollar is strengthening, which one is weakening, so that once you enter that trade, you are likely to get better results than pairing two strengthening currencies. So it's always better to pair where, to go for a pair where one is strengthening as the other one weakens. All right, and we're gonna see all that as we proceed with our classes. So remember, we said again, currencies are traded in pairs. Currencies are traded in pairs. So a currency is always traded against another. We saw that. So for example, we trade the euro. We trade the euro against the dollar. That is Euro USD. That's the pair. So in Euro USD, the euro is the base currency. Remember, we saw yesterday the currency on the right side of the slash. Here you may not have this. We actually don't use the slashes when you are pairing them, but you just use it for class purposes. So the one on the right, is the first one is the base currency. The second one is the quoted currency. All right. So like in Euro USD, euro is our base currency, USD is our quoted currency. So anytime you enter a trade for this pair, whether you buy or you sell, like if you buy Euro USD, you're actually buying euro, you're selling USD, all right? If you sell Euro USD, basically you're selling euro and buying you, because you're exchanging those two. So you're buying one and selling the other one at the same time. So in this pair of Euro USD, if the euro is rising in value, it is rising in value as compared to the dollar, which would make Euro USD to go up. Okay? So if euro is strengthening in this particular pair, it means it is strengthening as compared to the USD. So this pair in our price chart will start going up. Why do you think it's going up? Because euro is strengthening. So it means you need more dollars to get 1 unit of euro. All right. So because you need more USD, so the pair starts, in the price chart, the pair starts going up and up. Because euro is getting stronger, since you require more dollars to buy 1 unit of EUR. Okay. So if the euro is losing value or depreciating, Euro USD will go down. The pair on our price chart starts going down, because since USD is strengthening as euro weakens, it means you need less dollars to buy 1 euro. Like just a case like in Kenya, if the Kenya shillings is weakening, it means we need more Kenya shillings to buy 1 unit of dollar. The same case with this. So if euro is losing value, it means now USD is strengthening. You need less dollars to buy 1 unit of euro. So the pair starts going down and down. So in such a case, you sell it. All right, you sell the pair. When it's going down, you sell, because you expect it to go down and down. Then you liquidate your trade. When it's already down there, you take your profit. If it is going up, like when the euro is strengthening, then you buy it. In such a scenario, you're buying euro, you're selling USD. So as it goes up and it reaches the climax, you liquidate your trade, you take your profit, right? So in the pair euro USD, if the dollar is rising in value, it is rising in value as compared to the euro, which would make euro USD to go down, all right? Because dollar is strengthening, so you need less of dollars to buy 1 unit of EUR. And then if the dollar is losing value, euro USD will go up. It's just the opposite of what we said up there. We go to leverage. We also covered leverage yesterday, and we said because of the amount required to trade in the forex market, me and you may not have the muscle financially to participate. So to enable the retail traders, who is me and you, to participate in the market, brokers provide the resources. They enable us to participate by leveraging us or giving us a loan. It's like a loan they give you to enable you to buy in large quantities and make some money. Because remember, we saw they move in very small points, like 10 points and all that. So you need to buy like big quantities for you to make some reasonable amount of money. And we saw one lot is $100,000. So it means if we never had a loan, for you to just buy one lot, you need to look for that amount of money for you to be able to trade. But it's not possible. So what happens? The brokers, they leverage you. They give you a loan. Yeah. So it leverages borrowing money from the forex broker so that you can get an even bigger exposure to the market. You don't pay any interest on the loan. So a small amount deposited into your trading account can control a much larger contract value. And we saw, like the case of FXTM, the maximum leverage is 1:1,000, which means if you select that leverage as your leverage, it means for every dollar you invest, they give you 1,000 times for you to access the market. But again, we said leverage is a double-edged sword. It can work for you, it can work against you. So you have to use it wisely, all right? I encourage people to use to a maximum of 1:500. Don't take too much exposure, you risk your account. So because of that leverage, you can that's how even with $100, you can trade big amounts of volumes of a trade because the broker has loaned you some money. Remember, this loan is not just put in your account. It only becomes available when you enter a trade. So when you deposit in your trading account $100, that's the money you're going to see in your account. Yeah. But anytime you enter a trade, the leverage is automatically triggered, yeah, to allow you to enter big volumes of trades. Then we have pips. We also covered pips yesterday, and we said a pip is a percentage in point. So a pip is the fourth decimal point in the exchange rate. Remember, we said we measure our profitability or our losses in pips. Yeah, you can say I'm 10 pips in profit or 20 pips in a loss. Yeah, we don't say I'm $200 or $30. Yeah, because the value of a pip depends on the pair you're trading, all right? Because a pip in a Euro USD, it could be around $10, but a pip in CAD JPY is around $7. So it's a range plus or minus 10. For GBP USD, a pip is equivalent to around $12. So it depends. So many times we measure our profitability or our losses in terms of pips. And we count pips by counting the movement on the fourth decimal point. We had a cases, but I will also see an example here. But for when the yen is in the currency pair, then it only has 2 decimal points. So for yen pairs, we count our pips from the second decimal point. Any movement of the second decimal point means that's how we count our pips or our pips movement. The amount of pips the market moves determines your profit or loss. Although these currency movements may seem small, due to leverage used in the forex market, small changes can result in large profits or losses. A pip is equivalent to plus or minus $10 for a contract of 1 standard lot. And we're gonna see how that can be interpreted in the real market scenario. So we have a case here to see how we calculate this in terms of pips and how those pips are converted to money. So let's say you enter the market. That is, you buy GBP USD when it's at 1.573. Sorry, what is 1.5734? So you're buying because you're expecting it to go up. You've done your analysis. It tells you the pound is strengthening. All right. So the pair is gonna go up, because if the pound is strengthening, you require more dollars to buy 1 unit of pound. So from your analysis, it tells you the pair is going to increase in value. So you buy when it's at 1.5734. So, and actually the market now moves into your favor, it moves up. And then when it reaches 1 point, let's say your take profit is at 1.5818, and then it's triggered. It means your trade is closed. So how many pips did the market move and how much profit did you make, right? So we will take the exit price, that is 1.5818. You take away the price you bought at, just like the normal market, shop scenario. Yeah, if you buy a kg of sugar for 100 shillings and you sell at 150, what's your profit? 150, take away this is the selling price, take away the buying price. So the same case here. So we close our trade at 1.5818. We take away the price at which we bought the pair at. And our profit is 84 pips, right? So you say you have closed the trade at a profit of 84 pips. So if you had bought one standard lot of GBP USD, then you would make 84 times 10, because you said 1 pip is plus or minus $10. So the number of pips you multiply by the amount per pip. And for GBP USD, this is not news. This one sometimes can even move to 150 pips in a day. You just need to be on the right side of the market. It really moves. So this 84 pips is not something cannot happen actually. It can always move into 200 pips. It depends. Like I think the day of they voted for Brexit, it moved by more than 1,000. So just imagine if you had bought 10 lots. Anyway, it can always again move against you. So you always have to balance and calculate the risk. If it moves in my favor, I'm going to make some amount of money. Just in case it moves in the opposite direction, I'm okay to take this amount of loss, as we saw yesterday, setting your take profits and your stop losses. So due to leverage, okay, this is just stories, may not be necessary. So what happens for you to decide whether to buy or to sell? You have to do some analysis, right? And there are two types of analysis. One is technical analysis and fundamental analysis. For technical analysis, you rely on the price chart. You look at the chart, you look at how the price is moving, you apply your strategy, and then it helps you to know how is the market expected to move. Then you decide whether to buy or to sell. So you must do some analysis to know whether to buy or to sell. So technical analysis is based on chart interpretation. Just look at the price, or you use indicators. All right, there's also some built-in indicators you can actually use for them to predict to you how the market is going to move. But basically, we rely on the price chart, nothing else. All right. So technical traders are looking for the charts to show very clear setups. They also rely on indicators to try and predict where the market will move next. So that is technical analysis. You basically just look at the price chart and you analyze and you make your decision whether to buy or to sell. So how does the market work? Just give me 1 second. So remember we said yesterday, we have buyers and sellers, and the buyers are the bulls. They push the market up. Sellers are the bears. They push the market down. So at 1 point, Forex is just a fight between those two, the bulls and the bears. So if we have more bulls, more than the sellers, more buyers than the sellers, then the market is likely to move up. It depends on who is stronger than the other, who is buying more volumes than the other, who has put in more money. Is it the buyers or the sellers? It's like the issue of demand and supply. You know, the point of equilibrium when the supply is high, you know, those kind of curves we did in high school. So if the buyers are more and they are putting more money, they are going to push the market up. But if the sellers come in with a lot of force and they put in more money, then they push the market down. So it's a fight between those two. And it depends on who gets stronger than the other one. So whoever takes the day is one who controls the market. So in your analysis, you try to, as much as possible, to be on the side of the masses. Are the bulls getting stronger? Join the bulls and go up with them. Are the sellers getting stronger? Join the sellers and go down with them. You sell if there are more sellers. If there are more buyers, you buy. And you're going to see how do you analyze to predict who is in control for you to join the winning side. All right. So the bulls push the market up and the bears push the market down. All right. The Forex market is a free market and is not centrally governed or owned by anyone. So this means, so it is purely dependent on demand and supply, or the strength of the buyers versus the sellers. There's no one to say, no, today we're going to buy all this much to change the market. No, and there's no one telling the others, let's buy. You just look at the market, then you have the same kind of thinking or intuition. Because remember, we use the same kind of strategies, more or less. If you're technical analysis, you're looking at the same chart. Yeah. So it depends on people thinking the same way, because there's no one will tell people, no, it's time to buy, it's time to sell. No, it's a matter of how many are seeing the market with the same kind of eyes, and they're seeing the market in such a way to tell you it's time to buy. So if you have more people buying, the market will move up. We have more people selling, the market moves down. So this means that if 1 million people decide to buy at the same time, the people buying would be regarded as bulls and will likely push the market up. And if for the sellers also, it also works the same scenario. We have more sellers, they move the market down. So if the bulls are more than the bears, the market will move up and vice versa. Okay? So we said in order to determine when to buy and when to sell, a trader has to do a detailed analysis of the price chart. And for you to make, so a trader needs to make informed decision on when to buy and when to sell. So traders carry out technical analysis using what we call Japanese candlesticks. Okay. So you're going to see exactly what our Japanese candlesticks are. So basically, we are saying, just before I leave this chart, or that this page, if you're a technical and you believe in just using the chart alone, you have to be able to analyze and tell when are the bulls taking control. You go in and you buy. When are the sellers or the bears taking control? You go in and sell. So you try as much as possible to be on the side of the masses so that you move the market together. You don't swim against the sharks. Try as much as possible to swim with the sharks, and that depends on your proper analysis, and not try to just jump in because you see the candlestick is running or the price is running, you jump in. You have to wait and rely on your analysis, right? So we want to go deeper into market analysis and see what happens there, or how do we carry the analysis. Hope you can all see my chart. Can you just 1 second? Just give me 1 second, please. Somebody needs my help here. Still another trader who needs some advice on a particular graph. This lady. Sorry about that. So what happens when you open your price chart? There are three ways of presenting the price movement, or rather the patterns which they use to tell whether which direction the market is moving. It can be a line chart, or it's a line chart. The other one is bar chart, and then we have the Japanese candlesticks. So many people use the Japanese candlesticks. They are easier to interpret or to just communicate to you how the market is moving. So you are going to focus on candlesticks analysis, or rather the Japanese candlesticks as our price presentation of how the market is moving. So in order to determine when to buy and when to sell, so there's a story behind the Japanese candlesticks, story just from Japan and all that, but it's not necessary. Let's just focus on how we use the candlesticks to make decisions or to interpret the chart, the price chart, and we decide which direction to move. So in order to determine when to buy and when to sell, a trader has to do a detailed analysis of the price chart, just as I repeat what we shared earlier. So we are saying candlesticks are graphical representations of market price movements within a specified time period. All right. So we use the candlesticks to tell us during this period of time. So how did the price move? So a candlestick may represent price movement that occurred in the 1 minute, 5 minutes, 15 minutes, 30 minutes, or even 1 hour, 4 hours, 1 day, 1 week, or 1 month. So you just select the time frame you're comfortable with, yeah, for it to tell you within that 1 minute. So if you select the 1 minute as your time frame, sometimes in my analysis you see me write the word TF. TF just stands for time frame. Yeah, sometimes try to make, abbreviate almost everything to make your life easier. Yeah? So if you select the time frame of 1 minute, it means you're looking at the candlesticks which are opening and closing within 1 minute. So in that chart, every 1 minute a candlestick is opening and it's closing as the minute lapses. You can also select the time frame 5 minutes to mean if it's a 5-minute candlestick, every 5 minutes a candlestick opens, it runs for 5 minutes and it closes at the end of the 5 minutes. So depending on the time frame you selected, so it gives you the candlesticks for that kind of a time frame, right? So you can decide whether to use the long-term time frames like 1 day, 1 week, or 1 month, or short-term, can be 5 minutes, 1 minute, or 15 minutes. Yeah, but many times in my analysis I try to mix. I still want to check on the day candlestick, the daily candlestick, to know how did the market close yesterday. What is the market telling me? What is it signaling me about the buyers and the sellers, right? Then I'll also check the 4-hour time frame. What is it telling me? But for entry, I use the smaller time frames. You need to see before you buy, what is the market telling you right now? Although end of the day yesterday it told you, when you look at the daily time frame, the candlestick for yesterday, this is a message it is giving you. Then you check what about the 4-hour, what is it telling you? But you cannot enter unless you're not an intraday trader. Intraday trader, you want to open all your trades that day and close them that day, nothing left running. But there are people who want to let a trade run for 1 week or number of days. So it means in such a scenario you can actually use the long-term time frames even to enter your trades. Yeah. But intraday trader like me, you want to open your trades today, close today, you'll use the longer term time frames to tell you the direction of the market in the long term. But for you to enter your trade, use the smaller time frames to trigger your entry. Although the daily time frame is telling me the bulls are coming in, I want to check in the one minute and see, is it the time to enter? Or can I give it a few minutes? Then it gives me a signal, this kind of a signal, then I enter the market. And as we go deeper into analysis, we're going to see how we use these different time frames to make our decisions. All right. So these candlesticks are printed depending on the who is in control, whether they are the bulls or the bears. All right. So we're able to looking at a candlestick, whether it's a daily candlestick at 1 minute or a 5 minutes, whichever time frame. Looking at that candlestick, you can tell who is in control here. So we need to learn how to interpret a candlestick to know who is running the market, who is in control here. All right. So let's look at the bullish candlestick. And a bullish candlestick represents market prices that are moving up. It is called bullish because the bulls are in control, right? So the close, that is the end price, is higher than the open. Remember, they opened, then they pushed the market up, and then the time lapsed and the candlestick closed, all right? So for a bullish candlestick, the closing price is higher than the open price or the beginning price. This means that in that 1 hour, let's assume you're using 1 hour time frame of a candlestick. In that 1 hour, the market has moved from the open price. You can see it here, the green one. The candlestick opened here. So it moved up to close above the opening price, or the close is above the opening price. That is a bullish candlestick. So the open will be the market price at the beginning of the 1 hour. That's our opening price. Let's call it an open. So the candlestick opened at this price, right? Then it moves up and closes at the close. So the close is the market. The close is the market price at the end of the 1 hour. That is in case of a 1 hour candlestick. So whatever time frame you're using, that's the same interpretation. But it's a daily time frame of 5 minutes. So if the close is above the open, that's a bullish candlestick. So the high and the low, you can see below the open we have the low, above the close we have the high. So the high and the low are the highest and the lowest prices that were traded within that 1 hour respectively. Remember, we said Forex is a fight between the bulls and the bears. So they will not just sit down and let you run the market. There's a struggle, right? So in this case, when this hour started, the market price was at open. It opened at this level. Then the bears came in. They pushed it down, all right? Let me just pick something to show. So it opened here, so the bears pushed it down. The sellers pushed the market up too low, right? So when it got there, the bulls put themselves together, all right? Then they pushed it back up, all right? They came in, they pushed the market all the way up to the high, all right? So when they got here, the bears said, no, we're not letting you have control of the market. So they push the market back down, all right? But when they go to this price level, 1 hour lapsed, or whichever the time frame you're using, it lapsed. So the candlestick has to close and move on to start another candlestick. So that's how it works. The market opened here, bears came in, the sellers, they pushed it down up to low. This is the lowest point they could actually get. But the bulls took control again. They pushed it up. They pushed the market. They bought and bought and bought until they got the highest price possible during that time frame, or during that 1 hour, assuming you're using the 1 hour time frame. Then the sellers came in again. They pushed the market back down. So the fight is still, remember, they're not just sitting and watching. They are actually fighting and pushing. But whoever is stronger takes control and pushes the market. So when they got to the highest price possible, the sellers came in and they pushed the market back down. When they got to this price level here, the time frame elapsed. If it's 1 hour, it elapsed and the candlestick had to close and it moved to start another candlestick altogether. Hope you get. So that's a bullish candlestick. The open is below the closing price because the bulls moved further from the opening price, moving up. All right. Then you're going to look at bearish candlestick. It's just the opposite of the bullish candlestick. A bearish candlestick represents market prices that are moving downward. So the sellers are the ones in control. Just to note, you've seen the bullish candlestick is green. So we use different colors for you to be able to identify. So when you just give the market that command, you tell it you want the bullish candles to look this color. You can put whatever you want. If you like yellow, you will put them yellow. You know, it's up to you to decide. But you give them different colors for you to be able, just by looking at the chart, you can tell who are in control. Yeah. So in this case, if the bullish candlestick is, we've allowed it to take the color green, and you see there are many green candles. It just tells you from, by just at a glance, you can tell the bulls are the ones in control. All right. So, but you can give them any color. You can give them black. You can give them white. Just whichever color you're comfortable seeing on your chart. You can always select. But you have to give each candlestick a different color. You just give it a command in the chart. Tell the market you want the bullish ones to print like this, to print this color, and the bearish ones to print this color, and it's going to obey the command you've given it. So bearish candlesticks, we are saying it represents market prices that are moving down because the bears are in control. A bearish candlestick is the opposite of a bullish candlestick. It shows how prices have moved down within the time frame that the candlestick represents. All right? So bearish candlesticks are usually represented by the color red, but it's not always. You decide what you want. It just like there's that kind of adoption of these particular colors, but you're free to choose the colors your eyes like to see. Yeah, for them to read it's bullish or it's bearish. So in this case, you can see for the bearish candlestick, the open is above the close. To tell you here, the bears won the battle. They took control. They pushed the market and closed it below the opening price. All right. So the movement here, what happens? This candle, when that 1 hour started, the candlestick opened at that price. That's why we have the open price, right? When the hour started, the price was at that level. Yeah, we can actually say like the case of our CAD, USD CAD yesterday, it can be something like 1.2 thousand. All right, that's our opening price. So when it opened, the bears came in. Sorry, I need to. Just forget about all that. It's refusing to give me what I want. So the market opened here at this level here. So when it opened, first the bulls came in, and that's why we call this one shadows or the tails. Yeah, the distance between the open and the high, or the open and the close, or the close and the low, we call them the tails or the wicks. You know, a candlestick has a wick, so you can also call it a wick or a tail. Any of those, it's permissible. So when the market opened, this was the market opening price. The bulls came in, they tried to push the market up. This is the highest price they were able to reach. Then the bears came in, the sellers came in, pushed the market all the way to the lowest price possible. Remember, it's a fight. They are all trying to fight to take control of the market. Even when the sellers are pushing down, the market, they don't just sit on the side and watch. No, there are some also trying to buy, but they are outweighed by the sellers. So it means at this level, we have many buyers waiting here because they want to buy at the lowest price possible. So when it got to the low, the buyers came in and they started pushing it back up. When they reached this market price around here, that time frame lapsed. It could be 1 hour, 5 minutes. So the candlestick closed. So that becomes our closing price. So for a bearish candlestick, the open is above the closing price, and it has a different color. Remember we said you can always tell your system the color you want it to print, right? So that's it about. We'll use these candlesticks a lot, but I'm sure you've gotten it. You can always ask any question. Yeah, that's being the bullish candlestick. It's green in my case. Then the bearish candlestick, which is red. In our analysis, in our training, we are going to focus more on technical analysis. That's actually what we build our strategy on. So we're going to rely on these candlesticks for all our analysis. Of course, we said we cannot ignore the fundamental analysis, but many times they speak to each other. But you are just able to take precautions when you know there are some hot news being released or very crucial data, economic data being released by a particular country. But candlesticks will be our main tools we'll be using to our strategies developed around the candlesticks. We're going to use that to do our analysis, and then we make our decisions to buy or to sell. All right. So we are going to go deeper and go deeper into technical analysis. What happens? A series of these candlesticks, whether they are bullish or they are bearish and their tails, when they are printed, like if you pick the 1 hour candlestick or the 1 minute candlestick, a number of them, they tend to form a pattern. And those patterns, they speak to us something, right? So we are going to see when they print this particular pattern, what are they telling us? What can we tell? Or rather, yes, can we interpret the market to be telling us from the chart? So a series of these candlesticks, whether they are bullish or bearish or mixed, because many times they're actually mixed. So when they are printed, a number of them, they give us particular patterns. So we are going to see deeper and see when they print this kind of a pattern, what are they telling us? What is the market telling us? And what are we supposed to do to respond to the market communication and whether to enter a trade or to close a running trade? All right. So one of the patterns, we call it a trend. And we're saying a trend is the movement of price up or down or sideways over time. I'm sure you know just from a general meaning of the word trend. It means something is taking a particular direction. It's trending this way, right? So when you talk about a trend in Forex, we're saying the price is moving in either downwards or up or sideways. And sideways, we also say it is ranging, yeah? From up, down, but within a particular range of prices. So those are trends. So when price is consistently moving up, forming higher highs and higher lows, this is called an uptrend. You remember the highs and the lows, eh? Those highs and the lows are the highs and the lows of the candlesticks. This is the high, this is the low. So when the market, this candlestick closes here, another one prints and the higher is higher than this, and the third one, the higher is higher than the previous one. So the highs are getting higher. That's an uptrending market. You're going to see those patterns in a normal, our MT4 platform, that we used to do analysis. So we are saying when price is consistently moving up, forming higher highs and higher lows, we are saying each successive candlestick, it's higher. The high, it's higher than the previous high of the previous candlestick. Then the market is uptrending, it's moving up. And that is called an uptrend. When the price is consistently moving down, forming lower highs and lower lows, this is called a downtrend. All right. So remember, these lower highs and the lower lows are formed by the following candlestick. You find this one, the higher is lower than the lower of the previous, sorry, the high is lower than the high of the previous candlestick. So the highs are getting lower and lower. Don't get confused. I'm going to show you this. But this is formed by a series of candlesticks. They form these particular patterns, not just one candlestick you're looking at, but you're going to see all this, how it works. So when we have the highs getting lower and the lows are getting lower, this is called a downtrend, because now the trend is moving down and down. When price is traveling sideways, it is called sideways trend or a ranging market. The market ranges between two prices. It goes up, is at the upper level, bounces back, starts going down, hits the bottom. So it is ranging between two prices, an upper price and a lower price. So it's a ranging market, or it is trending sideways, no direction. Okay, the direction is sideways, so it is neither up nor down. It is just on a particular range. In such a sideways trending situation, price is neither going up nor down. All right. So we look at uptrend. An uptrend means that there are more buyers than sellers. All right. There are more buyers than. Remember, we said the buyers push the market up, and the sellers push the market down. So the buyers have pushed the price of that particular currency up. Trading is about supply and demand. If there are more buyers than sellers, the price will go up because the demand is high. The demand is higher than supply. So what happens? The price of the commodity goes up. Same case with Forex. When you have more buyers, tells you there's more demand for that pair, all right? More than it's being supplied. So the pair starts going up. So in this case, it's due to demand. There are more buyers than they are sellers. So demand pushes the price up. So remember, we say these patterns are not just formed by one candlestick, but by a series of them, all right? So they form this kind of a pattern. Or the candlestick, they form a high here. The H stands for high. Then the market starts moving down. The sellers try to come in, but they cannot go up to. So they try to bring the market down. You can see they come down. They hit here. The bulls come in. When the bulls come in, they push the market higher than the previous high here. All right. You can see this is H2. It's the H2 is higher than the previous H. Then the sellers come in again. They try to push the market down, but again they cannot go below the previous low. The bulls come in again, and they take it higher than the previous high. So here the bulls are in control. All right. We said it's a fight. That's why there are moments the sellers try to push down, because they are all fighting. They try to come in, push the market down. Bulls put themselves together. They push it back up. So as the highs get higher, all right, the highs of the candlestick, and then the lows get higher. You see, this low is higher than the previous one. This one is higher than the previous one. So the highs are getting higher and the lows are getting higher. So that is the pattern the candlesticks are forming when they are put together. And that is an uptrending market. All right. Highs getting higher and the lows getting lower. So the lows getting higher, sorry. So in such a scenario, even as we go into details later, because here you can see the trend is telling us the bulls are in control. So you are looking for opportunity to buy. Yeah. So what you will do, you will not just buy at this level. Let me first clear everything now that we've illustrated. So in an uptrending market, because the bulls are in control, you are looking for opportunity to buy. And for you to make the optimize or rather to make good use of the opportunity, you look for the opportunity to buy when the price is low, right? So let's say the first pattern printed. We have the first low here. It makes a high. Then it makes a higher low. It makes a higher high. So already those two highs and the two lows already given you a pattern. The market is uptrending. The bulls are in control. So now you are waiting for an opportunity to buy. So you wait for the market to retrace, yeah, to come down. As we go deeper, we are going to see which tools we use to determine how deep the market is likely to go, or rather how low is it likely to go. So you wait for the price there. You've done your analysis and now you are on this H. Yeah, you come when the price is there. And you've seen already uptrending. It makes a high, it went down and made a higher low. Then it made a higher high. So you are waiting for the market the sellers to push the market down. Then you buy when the pair is down, so that you make good use of the next move. You're able to liquidate at a profit. So you buy when the price is low. You buy here, you buy here, you buy here. Never buy at the highs, because if you buy here and then the market starts retracing, your trade goes into losses. So you look for opportunity to buy when the market has dipped, or rather it has taken a dip, it has retraced. All right. So in such an uptrending market, you look to buy, and you buy when the market is low. You buy at the lows. Then your take profits will be at the highs. Okay, this is why you take your profit at the highs. You buy, it goes up, you take your profit. Market retraces, buy again, it goes. All right. Great. So that's an uptrending market. The highs are getting higher and the lows are getting higher. So we go and check on a downtrending market. And that's the opposite of an uptrend. So for a downtrend, or rather a downtrend is the direct opposite of the uptrend. We said that earlier. Downtrend is when there are more sellers than buyers. Remember, we said sellers are responsible for pushing the market down. So when we have more sellers than the buyers, we expect the market to start moving down, or the price of the pair to start moving down, right? So downtrend is when there are more sellers than buyers. The sellers are pushing price down. So remember that the chart represents the current and historical price of that currency. So when there is more sellers than buyers, this causes price to go down. So again, you see the highs are getting lower and the lows are getting lower because the sellers are in control, right? So let's say you came in when the price was, let's say you came in when the price was around here, okay? Remember, you don't just, okay, sorry, you may not see that. Let me just clear and choose something visible. Let's say you came when the market was on this L2, okay? On the L2 then. So you can see the sellers are pushing. You don't just come and then you see all this red candlestick and you say, hey, they're in control. You just enter and you sell. You know, it's like entering on a train which is at a very high speed. You never know it's going to stop. So you give the market, you wait for the market to breathe. You wait for the market to retrace, because when you're selling, you want to sell when the price is high, and then you liquidate your trade. You close your trade and the price has moved down. That's how you make money. We said in Forex, you make money both ways. When the market is going down, you sell, you make money. When the market is going up, you buy, you make money, right? So when the market is downtrending, when the sellers are in control, we are looking for opportunity to sell, but sell when the price is high, all right? So you come in when the price is at L1, the first L here. You just wait, yeah? You may see such strong candlesticks, bearish candles, and just want to jump in. Just wait, all right? The market will always take a breather. This bulls will always push it in the opposite direction, okay? So from your analysis, you've already, when it starts moving to up, from your analysis, using the tools you are going to see, you've already determined how high is the market going to retrace, or how is the breather going to be, all right? So you wait for the market around here. So you're going to buy at around here, and you're going to see what are the indicators or the signals which signal you to buy or to sell, all right? So when the market reaches there, you sell, all right? Here you sell. The market comes down, you're already in profit. You take your profit around here. We'll see all these, how to determine where to place your take profit, or your stop loss, and all those other things. So for selling, you sell when the price is high, you liquidate when the market goes down, because now you're in profit. You wait for the market, it retraces again, you sell here. It comes down with you, you liquidate, okay? So you can always enter as many trades as possible, then you're done for the day, you let the market run, right? So this is a downtrending market. The highs are getting lower, the lows are getting lower. because the sellers are in control and they are responsible for pushing the market down, right? Now we are going to look at support and resistance. Let me see how much of it so that I don't give you too much in one day. Then you cannot confuse you. Great. We're just now going to cover support and resistance, then we can end the class there so that you can internalize and try to look for them on your charts. Tomorrow we are now going to look at the chart, how we can identify all this before we go into details. Yesterday we mentioned about support and resistance. They are like the floor and the ceiling, all right? Support and resistance levels represent key price levels where the forces of supply and demand meet, right? You find now there's like a point of equilibrium. The bulls and the bears, like they are all equal, the bulls and the bears. They're just fighting and they have, one of them has to break through, yeah, for them to get to the next level. So in the Forex market, the prices are driven by supply and demand. If there is an oversupply, prices will go down. Oversupply means there are more sellers. If there is a demand, price will go up. Basically, support and resistance, as we mentioned, it's like floor and just figure out yourself somewhere in a room. Let's say you're on first floor, all right? On first floor, there is a ceiling and there is a ground, there is the floor where you're standing. So when you're standing on support. Yeah, the one which is just at the bottom of your feet, that is the support. The floor is the support. Then the ceiling is the resistance. So if you jump with a lot of force and you hit the floor with so much force, it means you will break through the floor for first floor and then you penetrate to ground floor. When you go to ground floor, the floor for first floor becomes now the ceiling. Are we together? The floor for first floor now where you were previously, it become, because now you're on ground floor. When you look up, what was your support? What was your floor? It is now your ceiling. And that support resistance works. We're going first to see into detail, then we going to illustrate how this works. But basically that's what it means. Like you're in a room, so when you're standing on support. What is above you is the ceiling, all right? So like you're contained between these two strong levels, all right? So it depends on whether you jump with a lot of strength, then you penetrate through the ceiling to go to the second floor, or you jump, you hit the floor so hard you penetrate, go to the ground floor, right? So support is the price level at which demand is thought to be strong, enough to prevent the price from declining further, all right? So as the price declines towards support, which means it gets cheaper, buyers become more inclined to buy and sellers become less inclined to sell. So by the time the price reaches the support level, it is believed that demand will overcome supply and prevent the price from falling below support. Remember we said, sorry, I think there's a question. Yeah, I will explain it. Let me first of all explain this, the terms themselves, then we look at them, then I will illustrate again using the floor and the ceiling. I get your question, Francis. I will explain further again using the scenario of the floor and the ceiling. So we are saying when you do your analysis, you notice the market, the price is coming in, it hits there, it jumps. So this is our support line. And from your analysis, you notice it is the point where the price touches and bounces back. It means the buyers are waiting down here. They are waiting here. So when the sellers push the price, it hits there. The buyers come in, they outweigh the sellers. They push the market back up. Sellers coming, they push the market down. It hits this kind of the floor again. It bounces back. So this is like your floor. Yeah, it comes, it bounces back because the buyers are waiting here. When the price reaches it, because the instrument or the pair has become so cheap, they tend to buy more. But the sellers, they feel it has become too cheap to sell it, so they go back and wait up here. Yeah. So when the bulls push it back, they push it back down. So this becomes our support, where the price just touches and bounces back, touches and bounces back. Okay. But at some point, support can be broken if the sellers come with a lot of force. All right. Suppose they come with a lot of force, then they can break through support. Yeah. So once support is broken, it will become our new resistance. Now the market will be going up and bouncing back at this level. All right. But again, let's just go to resistance, and then I'll illustrate all this one in a whiteboard. It's gonna be clearer. So this is not our support. The bulls are waiting here. The sellers push the market, bulls come in and they push the market back up. So it becomes a strong, it's like a floor. They're unable to penetrate through. All right. Then for the resistance is the opposite. Resistance is the price level at which selling is thought to be strong enough to prevent the price from rising further. As the price advances towards resistance, sellers become more inclined to sell and buyers become less inclined to buy. By the time the price reaches the resistance level, it is believed that supply will overcome demand and prevent the price from rising above resistance. All right? So you can see the bulls push the market, bears come in, they push it back down. Bulls come in, so it means that the sellers are waiting on this line. Remember, we said we all use the same charts. All of us, me, the small traders, me and you, and those big banks and the hedge funds, they use the same chart and we interpret the same way. So when I look, I see this, the first touch here and the second touch here. Already in my mind, these are an area of resistance. So my expectation is that I need to sell at resistance. I need to wait here with the rest of the sellers. They are seated here waiting here. So when the market comes again here, we push it down. We are with them, right? Because we all interpret it the same way. When it forms these two touches, already that forms it's an indication, it's an area of resistance. The sellers are waiting here to push the market back down. So now I'll also join them, we wait here, all right? The market comes here, because I've now joined them, we push it back down. Another one will also notice, oh, this is a resistance, so we all wait here again. Then we push the market down, all right? But again, you also say the bulls can come with so much strength and then they break the resistance and they go through, right? Once they go through, what was resistance, it becomes support. So the price will always now come and hit here, bounce back up. So when support is broken, it becomes resistance. When resistance is broken, it becomes support. So I want to illustrate that now using the oh, sorry. No, not that. So let's say the market is moving up. So, okay, not even there, just a second. Let me even clear everything. This is our building. And this is, we have the first floor here, the second floor, third floor, and fourth floor. Okay. Oh, we must have a ground floor. We have a ground floor here. Ground floor. So let's say you're here or I am here. Okay, that is me. I'm on second floor. When I'm on second floor, this is the floor, this is the floor, and this is the ceiling. Okay, this is the ceiling. Forgive my writing may not be very clear. This is the ceiling, because I'm on second floor. Now, in the same scenario in Forex, this is support. Where I'm stepping is support, and this is resistance. Okay, so if I jump, I will hit the ceiling and come back down. Hit support and go back down. All right, but if I jump with so much force and I break through this line here, I now jump and break through the ceiling. All right, then I will be on third floor. This is the new me. If I break through, sorry, did I just do? So this is the new me because I've broken through the ceiling. Okay, so whatever was ceiling is now my floor. Okay, because I've broken through the ceiling of second floor and I'm now stepping on third floor. So whatever was previously ceiling is now my floor. All right, and then now this becomes the new ceiling. Yeah, the new ceiling. So we are saying when the ceiling or resistance is, so when this is broken, this becomes my new support. Whatever was the resistance is new support. And now there is a new resistance level, which is the new ceiling. So when resistance is broken, it turns to be support. Now price will struggle to break through coming down. Right? Now price will try to come down, hit support, which is now the floor. It's no longer the ceiling now. It's no longer the ceiling now. It is the floor. It will hit, bounce back. Hit the ceiling, bounce back. Okay? Until it either breaks down coming again or it breaks the ceiling and go up. But suppose I broke this floor. I jumped with so much force and broke and came to first floor. Right? This is the new me. Right? This is new me. So if I broke this floor, I was in second floor, but I jumped with so much force, I broke the floor. This becomes my new floor. And whatever was the floor previously, because now I'm here, I'm contained here, this becomes my ceiling. Okay? This is the kind of scenario how support and resistance operates. So it becomes, whatever was support, it now becomes a resistance. And then I have a new support. So the same case with buying and selling. When the price breaks support, that support now works as the new resistance. It will struggle to go up again. All right? Because we said we all think the same. All of us traders, we know this was support. We all know it's going to become resistance. So we'll actually, as sellers, we'll wait there so that when the market gets there, we all sell and we push the market down, because we are all psychological human beings. We are not robots. Yeah. So the same thinking I have is the same thinking the other trader in US, in wherever they are. So we will actually tend to wait at resistance and sell, or wait at support and buy. All right, until one of them is broken. And you know, when it is broken, it becomes the other one, depending on where the price has moved to. All right, so that's how I can explain the support and resistance. So support is the floor and resistance is the ceiling, in simple words. Great. Any question? Any question up to that level now? Is it clear? Support and resistance are not covered. I know that we've done quite something, but if you're following, I'm okay. There is no question. It will still be fine. So I think I'll just cover one more page. Then now we can call it a class. Tomorrow we look at these patterns now in the price chart. So we want to look at stop loss and take profits. We looked at them yesterday by definition. So we want to see how we place them and where we place them. But again, just by mentioning, we're gonna go into details later when you start using our tools to analyze. Take profit and stop loss. A take profit order is an order used to exit a trade. We said when you do your analysis and you realize the market is gonna go up to this level, then it reverses. So that becomes you place your take profit where you know the market is likely to reach. You don't just place it arbitrarily. You do your analysis and you're like, the market is going to come up to this level. So you place your take profit. So once the market comes and hits your take profit, you close your trade at a profit. Automatically closes the trade. So take profit order is an order used to exit a trade with profit. They are represented by the number of points or pips a trader believes a currency pair will rise or fall depending on his or her strategy and time frame. Calculations can be made using several tools, that is support and resistance. That's what we've covered. We're going to see how we use those ones to determine our take profit. Or Fibonacci levels, we're going to see that, harmonics, and depends heavily on the time frame. If you're trading on a 1 hour time frame and myself are on 5 minutes time frame, our take profits may not be the same, right? Basically will not be the same. If you're using a daily chart or rather daily candlesticks to do your analysis, and me I'm using the 5 minutes, our take profit and our stop loss will not be at the same level, and you're going to see how that is determined. So a higher time frame will allow the setting of wider targets, but this also will require a wider stop loss. So on the other hand, a stop loss is an order used to exit a trade at a loss. The trader limits the amount of loss he is willing to take for any particular trade, all right? So if you're selling, you said stop loss is you determine how much pips you're willing to take in at a loss, right? So you enter your trade, you take, the trade is the green line, This is where you entered a sell, you sold. So you place your stop loss there. You're saying, just in case the market moves against me, then this is the maximum number of pips I'm willing to take, right? Remember, as we said earlier, this market is downtrending. It came, made a low, it retraced, made a high, came down, made another low, it retraced. So now this person sold at this level. So when you sell here, you place your stop loss above your selling price, so that in case the market moves against you, this is the maximum number of pips you're willing to take as a loss. Then this is your take profit. You're saying when the price comes and hits here, close my trade at a profit, because this is a sell. You've sold. You sold, expect the market to move down. It actually moved down. Then your take profit is triggered and your trade is closed in profit. That's just an illustration of take profit and stop loss. When you're selling, stop loss is above the selling price. When you're buying, the stop loss will be below the buying price, because you're buying expecting the market to move up, right? So you're saying, just in case, peradventure the markets are moving down against me, that's the maximum number of pips I'm willing to take as a loss, all right? Great, I want us to stop there. Unless there is a question, then tomorrow we can now go into details about support and resistance and see other patterns. Any question? Francis, hope you got it after I did my illustration. You're happy, thank you. Lydia, your question, what TF would you recommend for take profit? Someone like you, I know, will be like full-time trading. You're better off trading with lower time frames. Yeah. Enter your trades using the 15 minutes, the 5 minutes, but you still use the bigger ones to do your analysis. But somebody who doesn't have time to monitor their trades in the course of the day, they are safer using longer time frames. Yeah, because someone like you who is doing the full-time trading, or me with full-time trading, it means those 15 minutes that when the trade goes into profit, I can comfortably go and lock in my profit. I can also close and enter again. But somebody who is already doing other chores, like you in full-time employment, you may not have the pleasure or the opportunity to keep on checking your charts every 15 minutes. So for someone who has other engagements, you're safer with long-term, longer time frames, all right? Like 1 hour, 4 hours, because you enter, you do your analysis, you enter your trade. Of course, for longer time frames, the take profit is bigger and also the stop loss is bigger. So you give your trade room to breathe, right? So if you're an intraday trader, the person who will open many trades and close many trades in a day, use lower time frames. If you have other engagements, like you're in full-time employment, then you're safer with longer time frames. So that's how it works. So depending on your time frame for trading, you place your take profit and your stop loss as per the time frame which matches your daily engagements. But for a full-time trader, it's better to work with lower time frames because you are there. You're able to monitor, close, enter another trade, all right? Unlike somebody who just wants to enter a trade in the morning and check it, just keep on peeping, but you can only change maybe at the end of the day or after a few hours because you have other chores which you engage in the course of the day. But again, we said even if you use the lower time frames, you have to peep and see what is the longer time frames telling you, all right? What are they predicting? Then from there, now you go to the lower time frames for you to enter your trade. Hope I answered you, Lydia. Great. Any other question? All right. If there's no other question, I think I'm going to end the class. I'll also share the recordings. You can always take your time and now listen to them at your pace. If a question arises, you can always ask at the chat, then we can be able to discuss. So I'll end the class there, and then now we can continue from there tomorrow. Thank you and have a good night.